Good afternoon. My name is Chris Jenkins of Untitled Chartered Accountants, and I'm joined here today by my colleagues Philip Williams and Rachel.doyle. We're also pleased to have Chris Evans and Hannah Belton of Morgan La Roche join us in our conversation today. We're going to be looking at the topic of succession planning and restructuring for the next generation, with some positive advice around planning despite the outbreak of coronavirus. As we know, having spent significant time developing a successful business owners should always ensure long-term plans are in place to provide security for their own retirement, ensuring that the business continues to develop successfully after days at the helm. In the case of an MBO or trade sale, it's always important to ensure others in the organisation have the right skills, knowledge and contacts to ensure the business is not purely dependent upon the leaving party. However, coronavirus came out of the blue and has certainly derailed those plans that were in place. Business valuations will need to be reassessed, which could impact upon the sales price and in turn impact upon the post-retirement lifestyle. But how do you prepare the financials when the landscape has changed so much and the future is so uncertain? How have the legals changed? What else do you need to reconsider or consider to protect yourselves and the business moving forward? Through our discussion today, we aim to give some positive advice and proactive steps to assist in succession planning. Chris, I'm going to come over to you first. I'm going to ask some questions to you all in one go at the moment, so apologies here. Do you anticipate that COVID-19 will have any impact on succession issues? And if it means that there's no succession, what are the options? Another thing is, around the legals. What are the legal issues planning that needs to be undertaken when dealing with succession matters? Are these changed because of COVID-19? And the last one, what are the benefits of a shareholders agreement and how do they dovetail in with some of the other documents such as wills, etc.? Chris, do you want to take it away?
Yeah, thanks for that. Yeah, I'll try and break it down into sort of obviously those are key areas that you've looked at. I think the initial sort of question you asked, what issues will COVID have really on succession issues? I think realistically, COVID has had a significant impact on sort of business planning and succession. COVID obviously has impacted different sectors in different ways. And for some business owners, they've been flat out if they've been in, for example, sectors such as logistics, whereas in some sectors they've had to close down and they've had to furlough all their staff. I think the only positive for the business owners who have had to close their operations down, it has actually given them an opportunity to sit down and carefully sort of reevaluate and look at their business structure and also look at succession properly. I think from our experience of working with business owners, they tend to be very busy, driven people who tend to be focused very much on the operational aspects of their business. And quite often we find that business owners may only well address succession when key issues such as death or ill health or retirement is pending. And the reality is at that point it can often be difficult to plan a successful succession. So interestingly, as a consequence of COVID, I've already had a number of inquiries from business owners who've had an opportunity to sit down and think about what their business structure needs to look like and what steps they need to take place to implement that. So I think there is definitely a positive to be gained during these sort of gloomy times in terms of business owners taking sort of responsibility for looking at their business structure. And also, if there is no sort of family to pass the business down to, there needs to be looking at what are the sort of exit routes are open to them, particularly whether there are any sort of key managers within the business that they can develop with a view to a potential management buyout. Or alternatively, how do they sort of develop the business and the value drivers with a view to getting a successful trade sale underway? And I think any of those plans is ultimately underpinned by a solid sort of foundation. And that usually means putting your house in order from a legal perspective, because that will inevitably make succession much easier at the back end. So by ensuring that there are proper sort of legal documents such as leases for any property interests, key employment contracts around key staff, and then shareholder agreements to deal with obviously shareholder issues. You've obviously, one of the sort of issues you've asked in terms of shareholder agreements, and I think the significant benefit to companies putting in place shareholder agreements, I think ultimately one of the key points is that it provides certainty to all the shareholders. They have a clear structure and know what is going to happen in different circumstances. And key issues that are typically covered by shareholder agreements are matters such as decision making and sort of voting rights, processes for sort of exiting a company, and also looking at what valuation sort of methods may be applied when looking at sort of exit situations. Also, importantly, they can include dispute resolution processes, as well as sort of dividend policies, so that everybody knows roughly what that policy is. And for a number of companies which may be held on a 50-50 basis, for example, it can also importantly include sort of deadlock resolution. And on the flip side of sort of advising clients who haven't got shareholder agreements, our litigation team, for example, often gets involved in deadlock sort of resolution disputes, because there is no shareholders agreement and there is no way to effectively provide an avenue for those sort of deadlocks to be resolved. So I suspect that business owners would potentially save significant time, costs and effort in terms of addressing these issues through a shareholders agreement, as opposed to obviously the risks and the costs that's faced with litigation in a shareholder dispute scenario. And you've also got to remember that most companies that have not given any thought to their structure, and if they've simply sort of adopted the Table A articles, and if they don't have a shareholders agreement, there won't be any provisions such as preemption rights, which means that that could leave the remaining shareholders exposed if one shareholder wanted to exit. So we quite often sort of advise on putting in place shareholder agreements, and it gives not just the business owner but his family, importantly, that clarity on what might happen in certain circumstances. We've often been involved in other situations where shares have been sort of automatically sort of transferred via will to another family member, and that has again resulted in a dispute scenario, because often that the family member won't have any necessarily skills or to be able to add any value to the company. And in that situation, often they're only interested in looking at what dividends they're entitled to, which often ends up in dispute. So I think there's a number of key drivers there for business owners, if they haven't already, to look at putting in place shareholder agreements. And I think realistically a number of businesses are now at a point where they're also having to reevaluate values based on obviously what has happened through COVID, and we suspect or expect that sort of the next sort of 12 months could be difficult in terms of the economy. So I think the key underlying sort of point really is to plan ahead in these situations and try and use any downtime that you've now got because of the situation we're in to plan ahead.
Thanks, Chris. Very informative, and kind of latching on to what you said then, and touched upon it earlier on about the kind of the valuations and reassessing the valuations of the business. It's projections, budgets, cash flows. They've always been an important tool for businesses to assure the successful running of a business. And those that didn't prepare them as a matter of practice previously, certainly have to get to grips with them now when looking for funding due to this kind of pandemic. Preparing projections is never easy. It's basically looking into the future and trying best to guess the financial figures and timing of the said figures as the best ways possible. And if the economic landscape itself is unknown, this adds a whole level of complexity. Rachel, I'm going to ask you a few questions now. How do you see the coronavirus impacting on future income and costs?
Well, that's a very wide question, I think, because as Chris has already said, depending on the industry that your business is in, You may well have seen a downturn because of COVID, but if you're in financial services or IT, manufacture of PPE, you might be actually seeing a boom. So I think any projections that a business owner might have had in place previously are basically been blown out of the water by COVID, one way or another. It's always been, as you say, a key part of succession planning that the outgoing business owner has got projections in place, because the key is in assessing how much cash may be available to fund his retirement. Now, you asked about the future income, as a result of coronavirus. It may be the case that income will, have basically tailed off completely. It may drop in the future. We may see a sort of W-shaped trend where we come out of lockdown and income comes up. But then what happens if we have a second wave? What happens if we have a second lockdown this winter? Income may drop again. And then if you're thinking about costs, you may have additional costs that you might not have had as a result of COVID. So thinking about making our premises coronavirus safe. So do we need to spend money on screens and signage, partitions, that sort of thing? Home working is likely to be on the increase, depending on the type of business that you're in. So there'll be additional costs there. We'll have, IT costs, monitors, phones for employees. But we might also see cost savings as a result of home working. So a business might be able to go down a path now where they actually save on establishment costs, because a lot of the employees are going to be based at home. So all in all, it's really unlikely that any pre-pandemic projections will still be valid. So when we're looking at future profitability, which is the first step in looking at future cash availability, then our advice has got to be, you need to reassess your projections, have a fresh look now.
How will the cost of a business exit be funded, as coronavirus-related loans and tax deferrals they'll need to be financed?
Well, yes, that's the next step, really. So we've talked about profitability and how it's going to look in the future. But in terms of succession, the importance of profitability is, at the end of the day, how much cash availability is going to be in my business to fund my retirement. Because, it's very common for outgoing business owners to be using the surplus cash within the business to help fund the retirement, because the incoming owners, especially when you're looking at MBOs and that sort of thing, people these days simply don't have the cash to buy into the business 100%. So that's the importance of looking at cash. Now, in terms of where we are as a result of coronavirus, well, a lot of businesses have taken out additional loans. We've got the coronavirus interruption loans, we've got the bounce back loans. Now, whilst the repayments for those may not kick in until next year, at some point they're going to have to be repaid. So that's cash coming out of the business. Then you're looking at deferrals of tax. So let's not forget that a lot of businesses wouldn't have paid their last quarter's VAT. They may not have paid the self-assessment payment that was due in July. They may have got time to pay arrangements for tax. So at some point, probably early next year, those tax payments are going to catch up with us. And those are just the sort of direct impact of coronavirus. Not to mention funding maybe losses that the business has seen over the last 3 months. Future losses, we need to replenish working capital. All this comes at a cost to cash. So whatever the projected cash flow, it is likely that an outgoing owner won't be in as strong as a position to fund his retirement through the business. And what is that going to mean in terms of how he funds his life outside of the business when he is retired? Is it all doom and gloom?
So with all this uncertainty, how are you advising business owners moving forward?
Well, I think the crux of what I'm saying in terms of projections is that we need to have a fresh look at projections. They're just one small part of a successful and good succession plan. And whether you're looking to retire soon or whether this is part of a 5-year sort of business grooming exercise, it's key that they're looked at now and looked at with a sort of fresh pair of eyes as a result of coronavirus. In my experience, retirement and succession planning is not only about the financing and the legals. Retiring from a business is like a highly emotional decision for the business owner. So what I'm seeing with my clients now, where they've had succession plans that were in the process of happening, they are feeling a lot of uncertainty and frustration because they feel they have to put their plans on hold for, maybe an indefinite amount of time. And they really want to be working in a business in 5 years' time, and now they feel they're sort of stuck with it. So my advice would be really, let's take a fresh look at the figures. Let's see what the cash position is going to be in the next few years, and it may not be as bad as you think.
Thanks, Rachel. We touched upon it earlier on, and Hannah, I'm going to come over to you in a bit now. A vital aspect of succession planning is always to ensure that the skills, the contacts, networks, they're passed on to the next generation, rather than being lost on the exit of a business owner. Hannah, with the exit of a business owner, it could create a loss of knowledge and contacts that we built up over a number of years. How can this be prevented in your experience?
Thank you, Chris. Well, in a perfect world, we would see owners and managing directors giving plenty of notice about their planned departure, helping to select and train their successors. But as we know, this isn't unfortunately always the case. Where owners leave, there needs to be a strategic plan in place to seamlessly replace them. The goal in succession planning should always be to ensure stability in the business, the sustainability, and most importantly for clients and customers, continuity. Additionally, a key part of succession planning is to develop the talent within the business to ensure that there is a leadership pipeline for the future, especially if we're also looking at future MBOs as well. So some tips for succession planning include to understand the organisation's leadership needs and business goals. What type of talent and skills and personality traits do you need to get there? What are your organisation's knowledge gaps and how can you resolve them? Proactively start preparing your emerging leaders to ensure a robust pipeline for the future. So look at your employees and provide them with consistent and meaningful training and development opportunities. Provide additional responsibilities and opportunities to help foster a deeper bench of future leaders in your organisation. So you could invest in middle managers, investment in training and opportunity, for example, makes them more loyal to the business and more likely to stay. There are also significant benefits from promoting within and growing your own talent. Obviously, by doing that, you capture the institutional knowledge, some of the things that are quite often lost when key members of staff move on. But you also can promote from within. It can improve team morale. People can see that there are progression in the career path that they've chosen to take. And it will increase retention and engagement across the rest of the staff. Obviously, as I said at the beginning, having consistent teams will serve clients and customers better, and it's obviously less costly to develop your own talent from within and grow organically than it would be to constantly do recruitment exercises and start recruiting externally. You could look at financially incentivising staff. You could be looking at things such as key performance indicators, linking that to performance incentive targets, share options and bonus schemes. But I think the key message is any change in leadership has to be communicated, not only internally, but externally, because otherwise the sustainability for customers and clients will have a knock-on effect.
Thanks, Hannah. What can be done to ensure that when the knowledge and the contacts are passed on, the recipient then doesn't leave and take the knowledge with them?
The key to doing that is making sure you've got robust contracts of employment or directors' service agreements in place. We're frequently trying to protect business interests by putting in non-compete clauses, non-poaching clauses, non-solicitation clauses. So you're protecting not only the data and the customer base that you have, but also protecting those good employees that you don't potentially want to be poached from your organisation into another organisation or to a new startup, for example. So each contract does need to be looked at on a case-by-case basis, because depending on how senior and how important the individual is, depends on how extreme those clauses need to be drafted. You'd also need to look at having confidentiality clauses in your contracts, and it's confidentiality not only during employment, but post-termination as well, to ensure that no confidential information is being used after the termination of employment. But also, since the General Data Protection Regulations has come in, organisations should be ensuring that their data protection policies are reflected in their contracts of employment and service agreements to ensure that no personal data is being copied, used or transferred in a way which is in breach of the Data Protection Act.
Thanks, Hannah. Phil, all good plans certainly need to be run through a good tax specialist to ensure they provide the most tax efficient solutions. Whether we're in normal times or during this pandemic, is it vitally important to get the sound tax viewpoint on any approach. I think it's a joint thought, you know, in light of all the government support that has been made available, that tax rates, reliefs, you know, they're going to have to change, you know, certainly to kind of recoup all the support that's been provided. A couple of questions for you now, Phil. What are your thoughts on the tax areas that the HMRC could change? Is there a window of opportunity now for businesses to act? You know, what's your best advice then for what business should owners be looking at now?
Thanks, Chris. Yeah, well, as you rightly say, the amount of money that the government has spent over the last couple of months has been quite eye-watering, really, and clearly it's going to have to be paid for in some way. And tax is obviously one of the main sources of government funding. So I think what is absolutely clear is that in the next few months, there will be substantial tax changes and increases in tax in the UK economy. I know one of the things that's often mooted is the possibility of increasing income tax, possibly increasing VAT. And I think that would be a possibility, but I don't think it's going to be anything too radical, because that is going to affect the ability of people to spend, and it's going to be people spending money, which is going to bring the economy back out of recession eventually, I would imagine. Similarly with corporation tax, there could be an increase in corporation tax, but again, I don't think it's going to be very substantial, because companies are already going to be suffering from, as Rachel has explained, there are real problems in funding and companies being able to, and businesses being able to repay the loans that they've taken out. We've already seen that something like the AIA allowance for capital allowances, we know that that is currently at 1 million, but that's only up to the 31st of December 2020, and then after it's going to drop to 200,000, which is obviously going to affect the ability of companies and businesses to reclaim on capital expenditure. So there are two main areas which I think the government could really go to town on in terms of trying to recoup some of the money which they have spent. And that is in the area of capital gains tax and also in the area of inheritance tax. With regards to capital gains tax, even before COVID-19, we've seen the entrepreneur relief fall from 10 million to 1 million as from the 6th of April 2020. And it wouldn't surprise me if at some time in the future, the rates of capital gains tax will increase. I mean, at the moment, unless it's a residential property, the highest rate of capital gains tax is 20%. I could easily see that increasing, not insubstantially, because it's an easy tax to collect on. The other issue with both income tax and is that it's very difficult to change a rate of tax mid-financial year. With capital gains tax and inheritance tax, that's not too difficult. You know, they can say, well, any disposals up to a certain date will be taxed at the old rates. After that, they'll be taxed at new rates. So I think capital gains tax would be one which we could see some radical changes in the next couple of months. I think one of the biggest areas is going to be inheritance tax. There was, even before COVID-19, inheritance tax was mooted as an area which was going to be undergo very substantial changes. And in fact, there was an all-party parliamentary group. So this is a parliamentary group made up of people from all parties who've made some very radical suggestions as to how inheritance tax might change. For instance, they have suggested a flat rate charge on death and lifetime gifts of 10%. That sounds quite good. However, they've talked about the abolition of business property relief, of agricultural property relief, the abolition of the residence nil rate band. Now, all these are very substantial reliefs when you come to look at somebody's estate. And I think one of the most radical ones that they've suggested is that pension funds could be taxed on death, could become liable to inheritance tax. Now, at the moment, over the last few years, pension funds have been a big planning factor for inheritance tax because they haven't been liable to inheritance tax. They've been a useful or the flexibility that was built into pension funds and being able to extract funds was something which lots of people have used. And that could be a really nasty hit if you're looking at in terms of people's estate. A couple of other things that they've mooted is that an annual allowance of 30,000 on lifetime gifts before you start having to pay inheritance tax on lifetime gifts. They've also talked about abolishing capital gains tax uplift on death, where at the moment, when somebody dies, if there's a property that's been bought a few years ago, the beneficiaries will inherit that property at the value at the date of death. So there'll be no capital gains tax on that increase from the day that it's been bought up to the date of death. What they're saying now is, well, we'll abolish that. The beneficiaries will acquire that asset, but it'll be at the value at which the deceased acquired it. So there's some really big changes possible in both in terms of capital gains tax and inheritance tax, which really blow some quite large holes in current inheritance tax planning.
Okay, so is there a window, kind of an opportunity for them to act now? You know, what's your advice then, really, to you know, what business owners should be doing, considering, you know, is it, you know, do something now, or is it a case of, you know, just wait to see how, you know, what's your advice, Phil?
I think people should be looking now to do things now if they possibly can. There's normally an autumn statement in November, which the Chancellor will give. And I would imagine, I think everybody was anticipating that the autumn statement in November would include announcements of tax changes. In the last couple of days in the press, that has actually been mooted that there could possibly be an emergency budget as early as the week commencing the 6th of July. If that's the case, then there's very little time left to do an awful lot. But let's work on the basis that things may change in November. So yes, if things change in November, quite often what happens in when they introduce measures during the year, they will say, well, as from the date of that announcement, things will change, especially on, as I mentioned, on things like capital gains and inheritance tax. So whatever is likely to happen, at the very most, there may be a 3 or 4 month planning window to actually think about doing something if that's possible. Okay, so I mean, there is a window of opportunity. It could be extremely small. At the most, it's not going to, you know, it's a matter of maybe 3 or 4 months. Thanks, Phil.
Thanks, guys. I know I'm going to kind of call it to an end there. I'm just kind of conscious to keep it as a smaller kind of session, bite size. So,
Chris, can I just add a couple of things which perhaps people might want to think about doing?
Of course,
is that okay?
Yeah.
I mean, obviously, this is at a time when share values are lower. Okay, so it may be a good time for businesses to start thinking about passing on shares to family members. Both Chris and Hannah have mentioned the need to maybe prepare employees or senior management, and Hannah mentioned share options. Again, this would be a good time to do it if the share values are low. If you use an EMI scheme, a low share value now would benefit the employee quite a lot when they come to exercise that option and dispose of their shares. But I mean, I think there are opportunities there, even if even if things do change quite radically. Okay. The other thing is, it is possibly for a business owner, if he doesn't want to lose control of the company or relinquish control at the moment, but would like to get rid of some of the value in that, especially if business property relief is going, is maybe the use of trusts with the children or other family members as beneficiary of that trust, owning shares in the company of a different class, different voting rights, but he maintaining control of the company through his voting rights. There are things which people can think about and which may be worth them doing. I mean, property companies are properties at a low value now, in which case it might be a good time to transfer them into a property company. There are plenty of ideas which can be worked on, which hopefully, as Chris said, people have got more time at the moment, and therefore they have an opportunity to think and to plan and to think what they want to do. And now is the time to, I think, to come and start talking and suggesting, well, I'd like to do this. This is how I'd like to plan, and to talk through with the likes of ourselves and Chris and Hannah, so that you can begin to get a plan in place. Okay, those are just a few thoughts.
Fantastic. Thanks, Phil. Okay, Chris, Hannah, do you want to kind of add anything on the end before we kind of wrap it up?
I think that's been quite a sort of good sort of overview in terms of some key action points for business owners to go off and have a think about. And as I said previously, just touching there on what Phil said, some business owners will have some time on their hands now to carefully look and plan ahead. And it's a good time to ultimately implement those plans, and, which many business owners always talk about doing, but never get around to doing. So now's the time to take it the next step, I think.
Fantastic. Cool. Are you happy? I assume you're happy for us to share kind of contact details that accompany this video, Chris, Hannah?
Yeah.
Fantastic. Okay. Thanks very much, Chris and Hannah of Morgan La Roche, Phil and Rachel of Gerald Thomas. We're going to circulate this video. Again, any kind of questions, any advice, just come and see myself, Phil, Rachel, Chris, or Hannah. We'd be more than pleased to kind of help you and advise accordingly. So look after yourselves, and thank you very much.
Okay.